Welcome to the latest Motley Fool Scoreboard. I'm Anand Chakamlu. We've got longtime fools Jason Hall and Matt Frankel giving a 1 to 10 rating to a company that makes stuff like arc welders and plasma cutters. It's Lincoln Electric, ticker symbol LECO. First, we'll rate the strength of its business, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Jason's got an 8 or an 8 plus. We're counting that as an 8. And Matt's got a 9.
Yes. So the name of this company sounds somewhat misleading. Like you would think it's an electric utility if you just hear what the name is, but it's really the leader in arc welding equipment. It does other things, as you mentioned. You said plasma cutters. It develops curriculum materials for welding schools is one thing it does. One of the kind of sneaky business lines it's getting into is developing EV chargers. So there's an actual electric business, but it has a wide moat in its core electric and core arc welding business, and that should keep the company profitable pretty much no matter what the market's doing. A very fragmented industry. They are the leading market share, but it's a very fragmented industry. A large market, big opportunity, especially when it comes to automation. In welding, you don't necessarily think automation, but there is a lot of opportunity there.
Yeah, there really is. It's an exceptionally strong core business. All the things that you talked about, Matt. I want to build on that too. They have a subsidiary business that's involved in more of the gas welding as well. So they have exposure to that part of the welding market and a really good recurring revenue business as well. A lot of the consumables that are part of welding. And if you're in a cyclical manufacturing environment like welding equipment is, having some sort of recurring revenue is good. And that's helped the business. I also have geographic diversity. Here's the thing, like thinking about the strength of the business. Since 2000, it's generated free cash. It's only generated negative free cash flow in 5 quarters. So 95% of quarters, it's generated positive cash flow. And every single year. Now, you factor in, again, cyclical business. Here's how cyclical it is. Over that 25 years, it's had 4 double-digit revenue declines during that period. And it's still generated free cash flow. That's incredibly strong, a really, really well-run business.
I love that curriculum thing Matt threw in there early. It's kind of like Apple putting its Macs in classrooms for kids. It's like, well, yeah, well, guess what kind of equipment you need to use? Lincoln Electric, right?
So Anand, the founder of the company, first started training welders back in 1917. This has been a part of the business for a long time.
Wow. All right, let's talk about management. And by the way, very far thinking. Let's talk about management. A 10 is Warren Buffett. A 1 is Homer Simpson. I'm assuming that original guy is not around anymore. Both of you have...
No, but his granddaughter's on the board.
Oh, okay. Makes sense. Both of you have an 8. Matt, what's the case here?
Yeah, Stephen Hedlund, he's the CEO. He is relatively new to the CEO spot, but he's been a leader at the company for 17 years now. He was the right-hand man to their former longtime CEO. And as Jason said, the family is actually still involved with this business. And if you look back to when it hasn't been a public company since, 1917 or whatever Jason said. But if you look back to like the last 10, 20, even 30 years.
It's 1896. They were a public company. It was 20 years later before they started.
Oh, there you go. So they have been a public. I looked at like the last 30 years of their returns.
Founded in 1896.
And they've handily beaten the market over pretty much any time interval is kind of my point there. So, you can't really argue with management's performance.
Yeah, no, I think that's fair. And again, the length of the time, this company's been around for 125 years. Like you said, Matt, more recently public. I also think it's notable that Hedlund has come in and not tried to change the business. They've stuck to their knitting for the most part, focused on the core business they're really good at, because there is an opportunity to continue to consolidate there. But also saying, hey, you know what? We're really good at this high amperage applications. You know what needs that? EV charging, DC fast charging. We're really good at manufacturing equipment that handles high current. This is an opportunity where we can take on some risk and maybe find a nice little niche business. So I like that they're being thoughtful about taking risk that is aligned with the business, but is not necessarily the kind of risk that can really upend the business over the long term.
1896, for the history scholars out there, they literally welded William Jennings Bryan's Cross of Gold. 1896. Not true.
There you go.
Financials. A 10 is a fortress. A 1 is yikes. Both of you have 8s once again, Matt.
I said an 8. You could make the case it's even higher depending on how you're looking at it. About $377 million in cash and no long-term debt at all. Great balance sheet. Sales did decline year over year in 2024, which is really why I didn't give it a higher score. And that wasn't really the business's fault. Globally, industrial spending declined. But the business is still very profitable. In a down year, it generated about $500 million in free cash flow. It's increased its dividend for 29 consecutive years. Really good financials all around.
Yeah, they do use some debt, some revolving debt as part of their working capital, but they're smart about the way they use it because, again, seasonality and cyclicality. But again, plenty of working capital. One other thing, thinking about the financials, over the past decade, they bought back about a quarter of the business in shares. So they are smart about looking for all of the levers to create per share value.
Jason, let's talk valuation. How well will Lincoln Electric stock do over the next 5 years, and how safe is it? 10 is a sure thing, 1's a lottery ticket.
So thinking about the looking at history, it's generated over the past decade around 12.5%, 13% annualized returns. So I think that 10 to 15% range is probably likely, maybe more likely to be at the lower end of that. My safety score is a 7. Matt and I agree. This is a wonderful business, and I've talked about how it's built to do well across the cycle. Opportunities for consolidation, but we're coming off a record year, and the stock, while it's down from the highs, it might not be as cheap as it looks. That 23 times free cash flow generated record free cash flow over the past year. So, and think about the dividend yield as a proxy. The dividend yield is a lot lower than its long-term average. So I love the business. I think investors make money, but between cyclical risk, near-term pressures that could weigh on the business, I think it's going to create value over the long term, but no guarantees that it's going to be a market.
Yeah, I also said 10 to 15%. If it didn't get to that level, it would be a disappointment considering how well the company's done historically.
Yeah.
So really to deliver like 15% annualized returns, it just needs to keep doing what it's doing. I said a 7 also for safety score. The business is somewhat cyclical and depends on things really even outside of the economy, like infrastructure spending, for example. But it's tough to imagine any scenario where Lincoln Electric loses its leading share, or even more unrealistic, becomes unprofitable.
Well, let's get on to top it to see if you all like any companies better. Jason, you're first.
Yeah, I like Chart Industries right now a little bit better, thinking about industrial manufacturing, especially businesses that have that strong mix of equipment and the aftermarket recurring revenue. And then thinking about tailwinds too. Infrastructure tailwinds are really big for Chart, whether it's liquefied natural gas, thinking broadly about cryogenic gases and industrial gases. This is one of the key companies in that manufacturing, not just in the US, but also really big in Europe. And again, looking back over the past decade, Chart has certainly been the better stock, while Lincoln's been mostly a market level performer. I think we're going to continue to see Chart be the outperformer.
I don't really have a better one. As far as like smaller cap industrial plays, this is one of my favorites. And that EV charger business that's just getting ramped up really kind of adds an X factor to it for me. So I said there's not really a small cap industrial I'd rather own.
All right. Well, thank you to both Matt and to Jason. They've given Lincoln Electric an overall score of 7.8 out of 10. That's just short of the 8.0 that would force me to own shares. But it's one that's been on my radar for a long time from people saying what a quality company it is. So I'll kind of keep it there and kind of elevate it a bit. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is online bank Axos Financial. Till then, Fool on.